Hello and welcome. This session today is on aligning transition and investors, how to highlight commonality. I welcome you all today and would like to start by thanking our sponsors. We are indebted to them for being able to put on this whole conference. They are Credit Suisse, Ping An, Moody's, Luxembourg Green Exchange, Citi, Refinitiv, BNP Paribas, IHS Markit, Alliance Bernstein, FSD Africa, IDB, ICMA, Zumo, GB TAP, Ashurst, Environmental Finance, Sustainabonds, Caxin, IPE, Responsible Investor, Kanganews and Eco-Business. And we are so grateful to all of them for being able to put this on today. I'd like to take us through a few housekeeping issues for the session this morning. We would like to use the Q&A box to ask questions. A number of our team are there ready to respond to answer your questions. Any other comments you'd like to make or just running chat goes in the section under chat. And you will see I've also popped a question under poll. Very curious to see your answers to that. Today, we are very lucky to be able to do live interpretation. So I will try and speak slowly to allow the translators to do their work. We have this available in Portuguese. We have it in Spanish, Chinese Mandarin, Japanese, and French. If you look for the headphone icon, you should be able to select the language that you prefer. Now, all sessions in the conference are being recorded and you can listen here on Swapcard until November. There's lots of amazing tools on offer in this conference. You can network with thousands of attendees. There's lots of virtual booths, lots to be explored within the website. For media, if you'd like to arrange interviews, please visit the Climate Bonds virtual booth to arrange these. I have just been messaged to say that I actually have missed one of the key sponsors, JP Morgan, so we are grateful to them as well. I would like to introduce you to our wonderful speakers today. I am joined today by Adam Matthews, who is chair of the Transition Pathway Initiative, James Mitchell, principal at RMI, and here today representing the Mission Possible Partnership. Esther Stoakes joins us from CDP, where she manages the Assessing Low Carbon Transition Initiative, and our own Anna Creed, Associate Director of Thought Leadership. Myself, my name is Michelle Horsfield, and I'm the Head of Climate Sustainability Standards here at Climate Bonds Initiative. So welcome today. We are organising this for you because we are united by pushing ambitious action and preventing greenwashing. We all are working in a similar space, often to different audiences, but the key message today, actually, it's a word of Adam's, is complementarity. For those of you who listened to the introductory opening speech this morning from Marissa Drew, you would have heard her say that we need to unite arms and get on with it. And this is very much the tone of this conversation right now. We are joining arms. We have much to offer each other because we work in such a similar space. So I would encourage you to have a look now at the warm-up poll to say, do you think, is there a role for initiatives or should governments be responsible for driving change? We believe here that there is definitely a role for initiatives like ours, and we will hear a little bit initially from each of our guests, particularly to get started so you hear a little bit about the initiatives that they're involved with. Adam, let me come to you first. Perhaps if you can answer the question, what's needed for the opportunity of leveraging finance for climate change to come about? And how does your work help?
Thank you. Thank you very much for inviting me. And sorry for failing to have the corporate branding behind me. I did try. I congratulate my fellow panelists on being more savvy than I am on that front. But look, I mean, as you say, this is the greatest challenge that we've all got to face as society, as investors. And to do this, we need regulatory environments. So there's an absolute role for governments, but there's a massive role for initiatives such as this in terms of the Green Bonds Initiative, and for tools such as TPI, CDP, etc. I think all of us have got an essential role to be able to sort of decipher what the transition really means. No one's done this before. It's deeply complicated. It's multi-decadal. It involves completely changing the way that we do business, the way we structure the global economy. Finance is absolutely critical to it. And to be able to sort of play the role it can and needs to, it has to do two things. One is be able to really understand the transition in a way that works to their agenda. And as an investor, I work for a pension fund as my main job. And we need to be able to understand what it means for our assets in transition and how we can equally play an important supportive role in the global transition. So you do need that understanding, working to the different constituencies of the finance sector. And equally, you need tools that can then enable you to put finance in a meaningful way and hold people accountable to what they've committed. And so I think working across the sort of the data providers, the different initiatives, it is opportune really to sort of bring that together within common frameworks, recognizing that there's different actors with different roles to play here. So I think there will be perspectives that investors will need that are distinct from others, but there's also an accountability in there. And I'm accountable to the beneficiaries who I have to provide a prevention fund for with our team. And we need to ensure that we manage our assets sustainably, but we want to do that in a way that really drives the transition, and having tools that work to that agenda while supporting the transition is going to be critical, but with that policy regulatory environment that is also enabling.
Great, thanks, Adam. Can you just give us a little overview of what the Transition Pathway Initiative is aiming to do? What's the key audience?
Well, I mean, it was established by asset owners fundamentally because we felt we needed a tool that explicitly worked to the agenda of asset owners. We sit at the sort of the top of the investment chain as such. We are the owners of assets, and we needed something that could sort of draw from data sources such as CDP, company disclosures, etc., and really sort of consolidate it in a way that worked to what we needed to understand of the transition. So over the past 5 years, we've been doing that through a free-to-use online tool based at the London School of Economics, Grantham Research Institute. And it really provides a very transparent assessment of companies as to whether they have the management capabilities and qualities that you would expect and need for a company to sort of engage with climate transition in hard to abate sectors, and whether that management capability is translating through to genuine forward-looking targets aligned to the transition. And this has involved developing methodologies for sectors, developing disclosure requirements, and importantly, the relationship with TPI and the Global Engagement Initiative, Climate Action 100, supported by $55 trillion in assets, is really important. We provide the benchmark to that initiative. And there I feel we're at the forefront of defining disclosure standards for the major emitting companies in the world, and really sort of working through what it means to be aligned to the transition, what it means in terms of company transition plans. And I think we've got a lot of work still to do in this area, but TPI really is there to provide an independent academic tool that supports our role in the transition and ultimately enables us as investors to play a constructive role in the way that we steward our assets, the way that we deploy our investments, and the way that we can support the transition.
Excellent, thanks, Adam. So similarly, you mentioned CDP. It's a nice introduction there to Esther. Esther, you obviously work for CDP, but your main role obviously is in assessing low carbon transition. There are many on this call who may not be familiar with that. Can you just give us a flavour for what that tool does?
Sure. So ACT, or Assessing Low Carbon Transition, I think the name is hopefully a fair indication of what we intend to do. So CDP co-founded ACT with ADEM around the time of the Paris Agreement, and we piloted our approach back in 2016. And since then, we've been working to develop methodologies that really answer the question of which companies are ready for the low carbon economy, and starting really from the companies themselves. So convening technical working groups with industry, with companies, with industry experts, because we know that the emissions reductions happen in the real economy, and data is important. But to have meaningful data, that's got to be grounded in the reality of what companies themselves are doing and what the best practices of those companies are. And we take that against absolute benchmarks defined by other initiatives to develop methodologies which can measure the low carbon transition for companies. And those frameworks help both the potential users of that, so those stakeholders, investors and others who may be interested in how well our company's doing. But it's also critical for the companies themselves that they have a clear roadmap towards the transition, that they're able to show that their own actions are credible and understand really whether they're on track or not and what they might need to do next. And every sector has a different role to play in the transition. The transition is very strongly connected to technologies and technology choices. So it's really critical that we get down into the depth and the detail of that for individual companies and ensure that the metrics that are being used within the company itself, as well as by investors, are really the most relevant ones. And all of that then does need to be supported, as Adam indicated, by strong management, strong strategy. Transition is long-term. And while it's important to look at modelling forward emissions, that needs to be within a context of a really strong management and governance framework and a real strategy, in many cases, to transform the business models of the companies as well. Because we know, that the business models of today are not going to be the same in the low carbon economy in the future.
That's great. Thanks, Esther. So your work very much for companies. Now, let me bring in now James. You work for the Rocky Mountain Institute's Centre for Climate Aligned Finance, and your work is slightly different, again, additional and complementing lots of what we've heard about so far. Why don't you tell us a little bit about the work that's going on where you are?
Great. Thank you, Michelle, and good morning, good afternoon to everyone listening in. So at the Centre for Climate Aligned Finance, we try to operate as something of an engine room to bring together those from the financial sector, the real economy, as well as experts to really enable financial institutions to better implement net zero commitments. So our view is that after years of increasing demands on the financial sector by advocates, customers, regulators, and others, the financial sector has now reached something of an inflection point. And this inflection point, we believe, is very well demonstrated by the increasing number of net zero commitments being made today by financial institutions across the globe. Recent research by the Centre, which I should say is only focused on financial institutions with assets exceeding 500 billion, shows that net zero commitments have now been made by large financial institutions representing over 70 trillion in assets. What we also know is that the conversation is now turning towards implementation, including, but also going beyond just target setting, touching on many of the topics that have already been mentioned by my fellow panelists. In other research by the Centre, a report called Breaking the Code, we conducted a broad analysis of trends across sustainable finance and commitment platforms and came up with a relatively simple encapsulation of what this trend means in practice. In short, the financial sector and individual financial institutions are being asked to actively participate in the pursuit of a net zero real economy. This will mean increasingly using the levers of influence available to sort of nudge the real economy towards these 1.5C aligned pathways. This will include using things like lending and investment decisions, advisory services, capital markets activities, and non-revenue generating efforts like stewardship and advocacy in pursuit of those pathways. Now, this will absolutely require the development, refinement of standards for the financial sector, and it will also and absolutely require governments to participate as well. I think our overall view on what's happening in the world today is that in the run-up to COP, we believe that the large thing that has changed is that now really every stakeholder across the economy, be that governments, corporates, and finance, very clearly has accepted that it now has a role to play. But as Adam has mentioned previously, each stakeholder also has its bounds. I think the lesson is that increasingly each of these stakeholders, be it finance, corporates, governance, will absolutely be expected to participate in the pursuit of net zero to the greatest extent possible. How this relates to the work of the Center for Climate Aligned Finance, we can get into this a bit more, but we work at 3 levels: the system level, the firm level, and the sector level. So at the system level, we think about how can financial regulation enable the financial sector to play this role. At the firm level, we think about what does it look like to transform a firm. At the sector level, it's a question of how do we make sure that we create a level playing field, the development of agreements like the Poseidon Principles, to make sure that there's a level playing field for financial sectors. Back to you, Michelle.
Great, thanks, James. Great. Now, I'd like to also, we haven't heard from my colleague Anna yet, and then I wonder, Anna, perhaps if you'd like to give me your thoughts too on what you think is needed here for leveraging finance.
Yeah, great. Thanks, Michelle, and hello, everybody. So CBI is obviously an investor-led organisation. We work initially and still predominantly, but not exclusively, in the green bond markets. What we hear from our investor partners, and there's a growing pool of them looking to invest in green and now in transition, but it can be challenging for them to identify what's credible. And credibility is really the key to getting these markets at scale, whether they're use of proceeds bonds or sustainability-linked bonds or other financial instruments. These things have to be credible for investors to really get into them in large amounts, basically. Not all of them have got the capability to do detailed due diligence themselves. So on that basis, CBI has been developing standards for the green bond market since 2012, initially for use of proceeds bonds. We really believe it's the way to scale the market, to set science-based and transparent criteria that are consistent for all players, aligned with the goals of the Paris Agreement. And we've developed those criteria for investments in many renewable energy sectors, buildings, transport, the land space, agriculture and forestry, and others. And we're now sort of branching into other sectors such as heavy industry or non-renewable energy as well, about transition there. As we move more into the transition space, it's not just about those people that are green today or nearly green, but those people that are actually do have a transition to make, either in terms of decarbonising their existing activity or switching away from what they're doing to some other kind of activity. So we're trying to cover all those parts of the economy with one type of transition or another. And like I say, we focused predominantly before on use of proceeds bonds, but now we want to be able to assess ultimately certify sustainability-linked bonds with their forward-looking KPIs. And that's what's brought us into this remit where the other organisations on this call and my other panellists are already working about company-level assessments as well, because they're really critical for those KPIs that we see in sustainability-linked bonds. So hence that's why we're coming into the same orbit now as everybody else. I'm going to speak later today about a piece of work we're just releasing about company-level transitions and assessments, which is very related to that. That's at 3:30 European time, 2:30 UK. But really what we're seeing now, I think, is interesting, and that this level of kind of standardization, organizations working together to harmonize and give real clarity to investors and other stakeholders in the transition as well, about actually what is needed to be seen to make this actually an ambitious transition that's going to get us to our collective goals of 1.5 degree warming or less, ideally. And that's the space I think that we're playing in along with everybody else at the moment, to support regulators going in advance sometimes of what they're doing. Yeah. Just a brief introduction. Thank you, Michelle. Yeah.
Yeah, great. Thanks, Anna. I think that's really important, actually, that piece that we wanted to communicate to our audience today is that these organisations are talking together. We're trying to find commonality where we can. It's really important that, for example, we choose a standard metric to enable the benchmarking to happen that has often been the reason for much of the struggles to date. So let me come to you, Esther. I know you've got some thoughts on increasing the commonality amongst what we're doing. How can we improve what we do together?
Thanks. Yeah, so I think I wanted to stress first that we have points of commonality, as we've said. So we all have that same essential goal, which is to ensure that we have a successful transition to a prosperous net zero economy. And what that transition entails is quite well researched. The climate issue is bounded by science. And there's many organizations who are working to define precisely those constraints and what that means for the economy, what it means for specific sectors. And as you know, my kind of organization and panelists here, we're looking to some of the same reference points and that knowledge base to define the transition. So we're all kind of working from a common knowledge foundation. And that's things like the work of the Science-Based Targets Initiative, which has been critical in establishing what should the level of ambition be. Of course, the IPCC, as I mentioned, to define, what are the constraints that are imposed on us by climate science to the economy itself. And the work of the IEA, especially, most notably this year, the 1.5 net zero scenario, to define and put that back, to what it means for those specific, for the energy within the economy and the sectors that are the most kind of closely related to energy-related emissions as well. So we're looking to the same sources, but it is a fast-moving field as well. We're all seeking to update, our standards, initiatives, and outputs as fast as we can. But the field is moving very rapidly, so that can be a point of difference sometimes. And as touched on, I think where we differ, it's our starting point and the user base. As we said, the transition is going to affect the whole economy, every market player, and they all have different needs. So it's right that we have initiatives who are responding to those different needs within the market as a whole. So for ACT, we're focusing on sectors with the biggest climate impact, starting point in the real economy. But that's really our starting point. And we want to establish, that kind of common language between companies and investors so that companies can demonstrate that credibility and that they can connect and show what they're doing in a commonly understood way. So I want to kind of reassure the audience today that alignment is very much on our mind as well. So we have this common starting point. We may diverge, that's necessary because, we're all looking at different audiences and trying to incorporate stuff as quickly as we can. But alignment is a real concern. So we talk, we refer to each other's work, and I think it's only going to become more important that we do that as the field evolves, with the rightful amount of interest that it's now getting. And there is a lot of work going on behind the scenes to ensure that we're aligning as much as we can. So I think, going forward, it's important that we have opportunities like today to come together and communicate publicly about the fact that, we do want to ensure that we do have alignment between our different initiatives, that we're serving our stakeholders, but we're not, getting into differences for the sake of being different, because at the end of the day, we do all have the same goal.
Great, thanks, Esther. Now, I said at the beginning there was a poll going on, so many of you will see this in the bottom right of your screen. There's a chat, there's a questions, and there's a poll tab. And I've asked the question in there, is there a role for initiatives or should governments be responsible for driving change? Now, interestingly, at the moment, the voting is showing that there's 91% of the audience is saying that there's room for both. But let me come on now to ask some of our panelists what the role is for organisations like ours in light of changing regulatory frameworks. Adam, can I ask you that first?
Yeah, I mean, a lot of the innovation is clearly going to come within initiatives like this and in the private sector and within finance. So, and that then in turn needs to inform policy. And often we can move a lot faster than regulation. So, but that doesn't mean to say that there isn't a role. These things, that policy and finance have got to move in tandem, and they can't get out of kilter too far. And at the moment, quite honestly, policy is lagging where finance has got to, and that's the concern for the Glasgow COP coming up. But just in terms of the specific of initiatives like the Green Bonds Initiative and efforts of investors, I mean, I think it's absolutely critical that we can work across jurisdictions to establish standards here of disclosure that can give us confidence as investors in terms of what a company is trying to do to navigate a very complicated transition, as I've said. We want to be able to provide transition finance. We want to be able to sort of invest in companies as well that are navigating this well, and we want them to succeed. And to do that, we need initiatives like this really that can sort of codify the best practice, to have that sort of interface between those that are sort of seeking that transition finance support and those that are actually potentially providing it, and those that are providing the data in between that can enable the decisions to be made to do this in as an ambitious but responsible way as possible. So that's where I think then you have that dialogue also with regulators, where that can flow into sort of different jurisdictions and processes thereafter. So I think this is critical. I think we've got to move at pace here, and I think we've really got to unlock the potential for finance to play a much greater role than it currently has. And I'm very clear that we need to join up the work that we're doing as stewards, as shareholders, with our role as owners of debt and providers of transition finance. And I think if we can bring that together, I think that really will be very powerful. And at the moment, these are sort of operating in silos. And I think initiatives such as yours have got a really important role to help bridge what the practices are to enable that, and to really sort of draw in to the kind of commitments we're making as funds to be net zero, and initiatives like Climate Action 100, which ultimately is the main interface with the major emitting sectors and companies. And from that will flow a lot of the sort of standards and frameworks as we sort of work out what works and what doesn't work.
That's right. Now, indeed, there's also a place where there's been some concern where we've got some gaps in the marketplace and in the guidance. James, what thoughts do you have, or perhaps ideas for what the market should do where there isn't guidance?
That's a great question. So I think there are three rules of thumb broadly. So firstly, I think refer to the science if there's no guidance that exists. And what I mean by this is, we are pursuing net zero by mid-century. And we at RMI and at the center think that as climate impacts become increasingly severe and increasingly transparent, or our understanding of those impacts becomes increasingly transparent, the need to achieve net zero will come increasingly into focus. So that focus on science does need to be at the heart of the response. Secondly, I think read the wind, right? So financial institutions will increasingly be expected to show how they are contributing to achieving a net zero real economy, going back to my previous comments. So focusing on contributing to net zero and thinking about how you can communicate that effort is going to be a very important part of your strategy. And then thirdly, build on what exists. So as you can hear there from fellow panelists, there's a lot of work that has already happened, a lot of extremely good work. So I'd encourage you to first look to sector-specific standards or thinking that already exists for other parts of the investment chain. So good thinking is available from organizations like the TPI, the Energy Transitions Commission, and others on sectors, Climate Bonds Initiative, just to name a few. If you still can't find anything, then I think look to general principles for guidance on what good looks like. That should give you a pretty good basis. And also I would note, do collaborate where possible with peers, as I think something we see as sort of an organization sitting on the inside track, the ability to work closely with many different types of financial institutions across the globe is, well, frankly, there's a lot of good work going on internally as well. And often there's a willingness to share that thinking.
Great, thanks, James. That's a really interesting point, actually, and something that we've seen a lot in our assessment of some of the financial tools that have come to market, particularly in the SLB sector. We've seen that companies have put together their own plans, their own targets. There's just a lack of credibility because often it's very untransparent as to how those plans have come about. So yes, your point there about collaborating with others, preferably in the sector, is a great one. Now, Anna, I wonder if I can come to you next. You've done a lot of work with the EU Taxonomy on sustainable finance, and that's probably given you a good overall about what's available at the moment. What do you think are the gaps that still need to be filled in this space?
Yeah, I think there's a lot of taxonomies being developed globally now, which is actually a really interesting and important development in Europe, China, Colombia, Chile, South Africa, Mongolia, Russia, Canada, Japan, India, all over the place, which is really fantastic. Just to pick up more specifically on the EU taxonomy, I think what's really interesting about it is two things. One, it really does have this ambition to cover the whole economy. And it's got a lot of sectors in there that a lot of us that looked sector by sector in detail haven't covered yet. So there's a lot of manufacturing sectors, chemical manufacturing, for example, a lot of detailed sectors and subsectors which aren't necessarily covered in other initiatives. I think that's really important. I think what the EU taxonomy doesn't have at the moment, though, is transition pathways. It almost has criteria for today. So it's a good starting point. This is what's considered good performance levels in terms of mitigation or adaptation in those sectors today. That's really great, even though they don't have the pathways on from them yet. It's a good start. I think what's really also interesting about the EU taxonomy is it's quite a coordinated framework, trying to bring together a lot of different objectives. There's 6 environmental objectives: climate change mitigation, adaptation, pollution prevention and control, water management, and biodiversity and healthy ecosystems. And I think the way they've structured that in terms of thinking about making a substantial contribution to one goal, do no significant harm to the others, is quite useful. Ultimately, at CBI at the moment, we've mostly done work around climate factors, not exclusively, but mostly. But as we see people issuing SLBs or other instruments, a variety of other instruments, there's a lot of focus on the SDGs and sustainable development more broadly, and now a just transition and pandemic bonds, etc. All of these need a transition. They're all goals that we need to meet for good biodiversity, for sustainable biodiversity levels, for example. What that actually means over time and how you integrate all these multiple goals is actually quite difficult and complicated. And at least the EU taxonomy is making a start on thinking about integrating a number of different goals at the same time. I think that's really valuable about it. But as I say, at the moment, the biggest gap that still needs to be filled really in the EU taxonomy is, yes, definitely some more sectoral coverage, but actually more that there's no transition pathways in them. And I think that's somewhere that all these initiatives that we're talking about and others elsewhere have really got an important role to play, that it's not just static criteria for today, and an indication that they'll be reviewed in 3 years or 5 years, but actually we need guidance to the market on what those pathways look like so companies can set those appropriate forward-looking targets as well.
Michelle, can I just come in here, because I think obviously it's tremendous what the EU's been doing in that regard, in sort of pioneering as a regulator. But I also sort of like, if we're thinking a few years ahead, how is this going to interrelate with what the US does? Does the US dovetail with this? Does it develop its own system? Does it its own requirements that potentially are similar but not aligned, and other markets? And I think we've got to be really aware, both as a sort of the technicians or the initiatives that the technicians in this area, that these things have got to bridge, and as Anna says, those pathways are critical to that, but equally that they can sort of talk to another to enable in the most effective way possible. And I think as companies, as investors, as practitioners in this area, I think there's a really important message to regulators in different jurisdictions to be able to really sort of ensure that we don't hit that scenario where you could see different systems of requirements potentially rubbing up against each other and making it difficult. And I recognise there's a sort of certain element of sovereignty in some of this with countries and jurisdictions, but actually we need to somehow make sure that that doesn't get in the way of ensuring that we can be as effective as possible in deploying capital to support the transition.
That's right. Thanks, Adam. I'm actually going to come to you again, actually, Adam, for this next question, because this point about the sort of the gaps, I guess I learned very much when hearing and listening to your very good, if I could just put a plug out there for those listening, you run a fortnightly podcast called Talking Responsibly. And one of the recent podcasts was on the work that you've done in the mining sector, looking at sort of the integration of some of the wider environmental, and in that particular example, the social factors. Can you just talk to us a little bit about how our work could be expanded to integrate some of those wider environmental and social factors?
Yeah, I mean, thank you for the plug for the podcast, which I wouldn't have the audacity to do myself, so that's really kind of you. In terms of the role of bonds in that, I just think that investors have got the opportunity to be much more creative in trying to work with the different sort of groupings that are going to need this sort of transition finance to support and enable the transition to happen at pace and to deploy different technologies to deliver on their strategies. And I'm sort of been looking with colleagues in other asset owners, the Swedish national pension funds and a range of others, that is there a way that we can actually get much more granular, rolling up our sleeves as investors in terms of understanding a national transition path, what the sort of energy needs are of a country, relating that to specific assets and companies operating within that jurisdiction, and really sort of trying to find a way to bridge the two, and then that we actually can have the confidence to come in at an earlier stage to be able to enable that transition, particularly in emerging markets, particularly in some of the more challenging environments. And at the moment, I sort of feel that we're quite distant from some of that as an investor from the role that we could be playing, and equally with some of the really difficult assets that do need to transition. But we also need to acknowledge that some of these national power systems are dependent on fossil fuels, that there isn't an immediate switch over alternative that isn't being used. It has to be created. And therefore, can we acknowledge that? And can we ensure that we're actually creating sort of bonds or interventions that can drive that transition in a more creative, ambitious way that is transparent and credible? And I think we're at the sort of beginning of looking at that in advance of the COP as asset owners, and looking at equally how tools like TPI and the initiatives on this can actually support us to have the confidence to play that role. And whether there's new factors or aspects to be drawn into that, I think that's to be worked through. I think the key thing for any company is you've just got to have a credible plan in the context of where you're operating at a macro corporate level and then at the specific project level. And that enables us to then understand the way that we can play. But I would say, don't feel you've got to create all the solutions yourself. I think we can actually be looking much more at sitting around the table with the different actors and actually trying to work through a collective challenge and trying to find pathways through there, so that we in turn know the wider context in which we can provide the finance, and then ensure that we've got the reporting standards, verification and ongoing accountability.
Great, thanks, Adam. Now, Esther, I know you two have done some work looking at integrating some wider environmental and social factors. Tell us a bit about some of the work that you've got ongoing.
Yes, so in the kind of, I think the next environmental issue is obviously very close to climate mitigation, which is what we've focused on here, on our initiative on to date. But adaptation is really a key partner, and sadly 2021 has shown us that that is only going to become more relevant in future for every company. So we've already started to integrate some adaptation indicators within the Act's agriculture methodology, which is currently being tested. And clearly, that's a demonstration of the fact that sector by sector, we need to look to which are the most relevant themes and issues that need to be addressed. And there are trade-offs and linkages between these climate impacts and other impacts across the board. I mean, certainly on the CDP side, in addition to getting climate data, we track water and deforestation. So since we started doing the ACT project, I've been getting questions from colleagues about when we might start looking at water and deforestation within ACT. And the framework that we've developed could potentially be expanded to look at those themes. So it's something that's of interest to us at CDP and at ACT, and our stakeholders as well. But I think it's really important that we are led by sectors. And I would say the biggest barrier to us in being able to assess the transition for these other environmental and social and also social themes is having that definition of what the transition looks like. We have decarbonisation pathways which give us specific amounts of carbon that can be emitted into the atmosphere by a specific point in time, and these can be calculated backwards to provide a benchmark for an individual company as to the amount that they can emit, and then from that we can pull out various technology options that need to flow from there. We don't yet have that for other environmental themes. Now that work is underway in terms of the work of the Science Based Targets Network, and others as well. And, we've also seeing kind of increasing international consensus around the need to defend biodiversity and put targets around that. That gives us then the reference point to what are we transitioning to. So I hope that this work can accelerate, but it's really important that we have that foundation and that base of the science there and the political consensus around what's the end point if we are to measure transition for these other aspects as well.
Great, thank you. Now, I mentioned at the beginning of the session we had a couple of polls. I would encourage you to vote for the next one. We're going to talk about that shortly. But also we've got some time in this session to ask questions. You can put your questions in the live discussion box and I can read those out to the panelists in due course. I want to shift now to talking about an issue that we're really wrestling with, I think, as a collection of initiatives, but also many investors are coming now talking to us about the issue about measurement. Now, many investors have been able to demonstrate the impact of their work by looking at carbon, measuring the carbon. And what we're starting to see is that investors are saying it doesn't seem to work quite as well using that metric for transition. So there's a poll question out there saying what metric could show the progress an organisation is making on transitioning to net zero. And 100% at the moment is saying that we need to find a new metric. So I wanted to ask our panellists what comments they might have on this. James, can I come to you first and to hear some of your ideas?
Yeah, tough question. So I think a couple of points here. So a focus on carbon broadly is very useful because it allows us to get the metrics right, or at least get the focus right, and avoid maybe what we think of as kind of an ESG challenge where everything is in scope and standardization is scarce. To give a very specific example, understanding total financed emissions might tell you where to focus your efforts, but I think as we've learned, such a metric might not tell you exactly what to do once you've identified that focus area. What that then raises is a need for, of course, robust industry-specific metrics to support a level playing field, but also a robust understanding of transition, which is as important. To give a very specific sort of example here, and let's just take the steel sector to kind of highlight the importance of transition. 7 to 8% of global emissions emitted from steel production. We're very likely to need more steel production year on year, but it's also imperative that we decarbonize this sector by mid-century, right? So what we see is both the need to understand emissions and have robust backward-looking benchmarks to help inform target setting, create a robust playing field, but also because of the complexity of steel companies, as well as because of the, well, as far as we know, the need to keep making steel, it's equally, if not more important, to also understand the transition so we can get the incentives right for the corporates who are responsible for making steel. We believe that both are crucially important in the pursuit of getting to net zero. Second broad point is a focus on carbon shouldn't come at the cost of all other issues, social, environmental issues, and in particular, equitable development. This is very important. And so I think this is, for us, this is more about making sure we get sort of box one right and making sure that we also have an appropriate focus on getting the next issues right as well.
Great, thanks, James. Anna, what about you? What are your thoughts on this question?
Yeah, thank you, Michelle. Yeah, given the climate science is the kind of boundary for this work on transitions, for me it is about sort of greenhouse gas metrics at heart. They're forward-looking, obviously. It's not about are you the best in class or are you reducing versus your previous emissions level or even what your business as usual would have been, but actually what are the forward-looking targets? What's possible? I agree completely. These are sectoral specific targets and pathways, but what's possible for this sector for good performance based on technology developments, etc. in the sector. There might be some sort of proxy indicators for that, so that we're not actually asking people to do greenhouse gas accounting if we know that there's a good indicator which mirrors the impacts of greenhouse gas. So I don't think it has to be necessarily asking people to do in-depth greenhouse gas accounting. If the work can be done in advance to say, well, these are the pathways for that sector. This is what the emissions profile for that sector looks like. This is what drives that profile. It's about switching to these technologies or using these inputs or using this energy mix. So maybe you can use those kind of indicators instead. But still, it's because you'll be able to link those indicators to emissions themselves pretty much in a kind of life cycle way. I think we do seriously need to be talking about scope 1, 2, and 3 emissions, at least in consideration for those pathways, etc. So that's probably where I would focus and answer in terms of what we would be looking for from those kind of metrics, essentially. Yeah. Great, thank you.
Yeah, so fair enough, I think, to say that we're seeing sort of perhaps the limitations now of measuring just carbon. We would be delighted to hear your thoughts. Anyone listening to this, do get in touch. It's an issue that many of us are wrestling with. Adam, did you want to add a comment on that?
I mean, I agree with what my fellow panelists have said, but I think really to sort of underline that aspect of the just transition, which I think we all completely subscribe to, but actually ensuring that we've got an understanding of what a transition plan means, not only in the sort of the carbon context, but the context of impact on communities and workforces and in different areas. And I mean, one of the things that we're talking about at the moment is individual transition plans for each individual, say, coal plants around the world, so that we understand how that plant can transition, what the impact is going to be in terms of the workforce and the communities, and how that can be managed alongside that transition plan and as part of it, and that we have that kind of granularity and understanding, and that's absolutely built in. So we do need a range of metrics. We don't need one. I think investors, all of us are very capable of using multiple sets of information, but I think the point on just transition is going to be critical in being able to sort of play the role that we need to play here and to do it justly.
Yeah, absolutely. Okay, we've now got some time to take some questions. We've got a couple of questions coming through on the panel. There's one question there for you, Adam, actually. It says, is your assessment template only for stock market listed companies? Can it also apply to SMEs?
Yeah, so at the moment, we've developed TPI over the past years by working with the largest listed emitting companies. But I'm pleased to say that in the next few weeks, we are moving into non-listed companies. We are looking at and we're also including metrics on their existing debt, so that will be profiled alongside the assessment that TPI conducts of a company. And we're working with Professor Andreas Hoppner at UCU in Dublin on that. And also we are expanding into sovereign bonds, working with all the investor networks to establish a common framework and tool that we can look at sovereign debt too. And so TPI is really sort of branching out and expanding its coverage quite considerably, and a lot of that will flow through into different asset classes as well. But we're very open to feedback. We've obviously started with the major emitting listed companies, but we think a lot of the principles that are being codified in the work with the largest within that group, in the CA100 target group of companies as well, flow through to other sectors. And the other area that we are working actively with investors on is really sort of understanding how a sector or a company transition plan relates to its whole value chain, and sort of knitting those pieces together. There's a lot of similarity there with the work of Mission Possible and the efforts that they've got. I think that how we draw that together with the role that investors and the tools that they use can complement that understanding and work is going to be really important too. And there clearly you work through a much broader grouping of listed private companies, and I think knitting that together both at an understanding level, but equally I think you'll see accountability flow, because I think a lot of the finance that will be provided, debt refinancing, new financing for transition, will be dependent on our understanding and these frameworks. Great,
thanks, Adam. Okay, next question here. This one's for you, Anna, on the EU taxonomy. We have a question from Gregor who says, my take on the EU taxonomy and reporting tools in general is that it's great that we have a framework available on reporting, but how will that be more than just that, a reporting tool? Are you able to answer that?
Yeah, I think it's very interesting because obviously it's the regulation around the taxonomy is about disclosure. It's essentially mandatory disclosure now. And it's not just investors that need to disclose, it's large, companies that are subject to the non-financial disclosure directive, so large companies also need to disclose. I think that was fairly late addition, actually, the large companies part, and it's a bit of a game changer, because one of the things that makes it difficult for investors and financial institutions generally is access to information about the companies they're investing in, but actually making the EU taxonomy disclosure requirements applicable to large companies as well really helps that information flow up to investors as well, so that actually that transparency over data and people's levels of performance, they don't have to comply with the criteria in the EU taxonomy. That isn't at this stage the requirement at all, but they have to disclose about it, so investors can make more informed decisions now about who they might want to invest in at a much more kind of whole scale level. And I think that's pretty much a game changer, that level of transparency will have a big thing. And then, as in many things, that we hope there'll be a race to the top here, that actually once these things are publicly known and publicly accessible, then there's a much bigger push on people to actually perform better, to make sure a greater proportion of their activities do comply with the kind of criteria for green and sustainable in the EU taxonomy. So it's the start of a very virtuous circle, I hope. And I think the great thing about regulation of any sort, but including the taxonomy, is the reach that it has. So we've all been working in the sustainable finance markets for a number of years now, and they're growing at pace. But actually, once you get this kind of regulation in place, that many more people have to engage with what sustainable finance mean, I think that's a real game changer that we'll see a lot of knock-on effects for that, not just in the EU either, given its impacts on international investors that were affected by activities or investments in the EU as well. Is going to be pretty big. And it's also having a lot of ripple effects already about conversations across regulators about, what's in their taxonomies, harmonisation across them, etc. So it's a pretty powerful tool, and it's a great place to start, and we'll see what comes off that in the short term, I think.
Great, thanks. Now, Adam, we heard a little bit from you about the plans for TPI and the future work that you've got ahead of you. I wonder if we could hear perhaps from some of the others too. Esther, what could we be looking out for coming from CDP's work and from the ACT initiative in particular?
Yeah, quite a lot on the CDP side, an awful lot as we go towards COP. We have the ambition for 1.5 for companies and lots of other excitingness as well. On the ACT side, so you may have seen our benchmark of the 100 largest oil and gas companies in the world, which follows ACT methodologies. That was delivered with our partner, the World Benchmarking Alliance. We've previously worked on electric utilities and autos, and we will be updating those benchmarks in around COP this year. So just within the next couple of months, you'll be able to see how those critical industries for the transition are performing, and that includes both listed and non-listed companies. So it's quite interesting, especially for oil and gas, to see some of the big national oil companies and how they fare. On the methodology development side, we now have 10 ACT methodologies available on our website for anyone to access and download. And we will be adding to those with iron and steel and agriculture and agri-food by the end of the year. They're currently being tested. We're also testing aluminium, glass, chemicals, and pulp and paper. They'll be ready next year. Once that's done, we will have coverage of pretty much all of the high impact sectors identified by TCFD. And we're also looking for other collaborations. So coming soon is a collaboration with the Climate Transitions Pathway to look at transition in the insurance industry, and defining that and engaging with some specific companies that are targeted as well. So lots there.
Excellent. Thank you so much. I think there will be so much material that is produced for COP that I'll probably need to spend the time towards the end of the year reading and getting through all of it. There's so much being generated, isn't there? James, what about you? What's happening in RMI? What can we look out for from your work?
I'm here really wearing two hats. One is, of course, the RMI hat, and the other is the Centre hat. The Centre is just a distinct program within RMI. So firstly, with my RMI hat, RMI is one of the founding partners of the Mission Possible Partnership, as has been mentioned previously. Some exciting developments at MPP, the launch of what's called the Steel Transition Strategy, which is going to be a very interesting and granular look at forward-looking steel sector decarbonization pathways. So very interesting, and that work should be published later this year. We're hopeful that future sectors will follow. At the center, some exciting things coming as well. Firstly, some alignment principles written from where we sit and who we work with. Secondly, updates on our own work in steel, as well as an announcement around sort of sectors for future work. So do stay tuned for that, and more work to come.
Great, thank you, James. Okay, so looking now just to kind of wrap up, for those of you in the audience, please do continue to submit your votes on the poll. Still very interested to see the outcome of that. But as we look to wrap up now, if I could come to each of our panelists and give you the opportunity just to say perhaps a final piece of advice or the main message that you'd like the audience to take away. Esther, could I begin with you?
Thanks. Yeah, I just wanted to echo a theme that's been picked up across the panel, really, which is to use our work. I think it does seem that there's been an explosion of interest in the transition recently, which is really exciting. But there's now a lot more being produced. But I would want to say that we on the panel have been working on this for some time, as have many other people, and we've distilled down a lot of knowledge that's really relevant, and we're putting it out there in the public domain to be used, to be referred to. So please do look out for what other organisations have done. There is no need to reinvent the wheel. And as Adam alluded to, collaboration is key. And we need to have a better information flow, and we need to be getting people around the table, investors, companies, facilitating initiatives, data providers, to ensure that we can efficiently work towards that common goal. So I mentioned rattled off a huge list of sectors earlier. That's all there. We also have the ACT framework if you're outside one of those sectors that captures some of our thinking. But yeah, use what we have, and we are ready to collaborate and actively looking for new ways in which others might seek to use our work and to put that knowledge into action. So hope to hear from some of the audience.
Excellent, thanks, Esther. James, what about you?
I'll just reiterate the points I've made previously and that have been made across the panel. So firstly, refer to the science. It's the direction of travel. Secondly, read the wind. The expectations of governments, of corporates, of financial institutions are traveling in one direction. I think the quicker that you can get ahead of that, the better. Specifically for the financial sector, that's going to come down to seeking to have and demonstrating real economy impact. And then finally, build on what exists, right? So think about sectors first. That's how you'll get that real detailed understanding of what needs to happen with the transition. If there's nothing there, which is very unlikely, then look to general principles. But do also note that collaboration is really key in this space.
Great, thank you, James. Adam, your final piece of advice in 30 seconds or so.
Well, I'll reiterate everything that Esther and James has just said, completely agree, but also just be clear about the challenges that you specifically face within your entity. Outline what that is. If there's aspects that you haven't worked through, be open about it. I think that's a strength, that's not a weakness. I think you can invite support from those that are invested in you or potentially could be supporting you. And so be clear about that, but also understand what are the policy measures that need to change, and be willing to speak publicly in relation to that or advocate through industry associations for the change that needs to happen, because these have got to work in tandem and not in isolation.
Lovely, thank you, Adam. So as we come to wrap up now, I just want to say thank you to each of our panelists, to Esther Stoakes from CDP, from James Mitchell from the Centre for Climate Aligned Finance at RMI, for Adam Matthews from the Transition Pathway Initiative, and of course our own Anna Creed. We've been delighted to share our thoughts with you today. We organised this very much because this is about uniting to push ambitious action and prevent greenwashing. We're working together, similar work, often for different audiences, but we feel very much that we can complement each other's work. Do continue to use the poll and post your questions as you need, and get in touch if there's anything you'd like to follow up with. Thank you all.